Welcome to FinTech Confidential, bringing you the people, tech, and companies that change how you pay and get paid.
So I've been in this space about over 20 years. The banks always had this mindset: the bigger the problem, the bigger the bag of money that you throw at it, and hopefully the problem's gonna vanish. And I was like, wow, this is mind blowing.
You're talking about problems not being solved.
You have no customers and you don't know what to do with your life, and you start watching Netflix.
How did you not go to like venture capital to get rolling?
I didn't pay myself for the first 3 years. 3 years, nothing.
So you went completely against their guidance.
We're also in control of our own destiny.
But why do you believe that most firm founders stall?
Your customer is why you exist. Don't do it, right? Find a team. It belongs to them.
What does it really take to scale a team to 40, 50 people?
And it shocks a lot of people.
What are the three most common mistakes companies make?
First principles thinking, missing in compliance is a huge problem.
Compliance can be done right, and it can be done wrong.
Less than maybe 4% of CCOs who I know in this industry who are really the real deal CCOs. Large language model, these are your friends and not your enemies. But we don't know how we're going to make money.
Focus on profitability and you'll be okay. Hey, Ted Huff here. Ever thought about how you could streamline your application and underwriting process? Well, let me introduce you to Under. Why keep using the outdated methods of PDFs when you can digitize them effortlessly? All you gotta do is upload the PDF, send it out for digital signature, and voila, you're set for the digital age. Are you curious on how to make that happen? Head over to under.io/FTC and get started for free. It's really that simple. Welcome to FinTech Confidential Series, Leaders One-on-One, where we sit down with FinTech leaders to learn about what drives their passion for FinTech. Leadership lessons. I'm your host, Ted Huff, and today's guest is Jas Randhawa, founder and CEO of Strategybrix. Jas, welcome to the show, man.
Thanks, Ted. No, thanks for having me here. If you would not have invited me, I would have probably hijacked the show or paid you a bunch of money to be here. I'm really happy and excited to be here.
Well, we'll go ahead and accept the money. So you don't have to worry about it. Go ahead and send the check over. We'll accept it with no problem. And one of the things I think super important, Jas has a resume that includes building leading compliance programs at companies like Stripe, Airwallex, and PwC. And he's actually bootstrapped Strategybrix to a 40+ person firm. And he's working with high growth fintechs and exchanges and partner banks. And during our prep call, one of the things he said that really stuck with me, and I laugh a little bit about this because I feel it as well, is he said, I'm the worst CCO to hire because I'm too commercial. And folks, this episode isn't about compliance as a blocker. We're really going to be talking about how compliance is a growth multiplier. And so I'm excited to get into this. So I touched on it really quickly that you built Strategybrix, bootstrapped it up from just the ground up. You turned it into a no VC zone, but you've done fantastic with it. And a lot of people would think, okay, how did he pull that off? And I start to think back to our discussion and looking at the customers that you have, and you chose fintechs and crypto over the traditional banks. Why did you do that?
So I think there's like two parts to that question. Let me address why we chose the market that we're in. And then maybe at some point in the conversation, we can talk about why did we keep this as a VC-free zone. So I've been in this space about over 20 years. The first, and my background is that I'm a computer science engineer by training. So I knew how compliance systems work in the back end, right? From like KYC, KYB onboarding systems, transaction monitoring, fraud detection, sanctions screening. And my first 10, 12 years, I was in New York and in London doing a lot of remediation work for tier 1 banks. My first big client was Citibank. The second one was JP Morgan. Third one was Deutsche Bank, HSBC. So all of these banks, starting 2008, were the ones in that sequential order that got into trouble. The one observation that I had during my time at the banks was the banks always had this mindset of the bigger the problem, the bigger the bag of money that you throw at it, and hopefully the problem's going to vanish. When you look at consultants, vendors, software providers, they've done really well with banks by selling services, by selling products, and just getting into partnerships. But when you truly look at the infrastructure of some of these big banks, the infrastructure hasn't really moved that much. If you look at the problems, still the same set of problems. The issues are still very consistent. The development of their products and applications still pretty slow. And again, I do want to give these banks some credit too, because if you look at a bank like, let's say a Citibank or a JP Morgan, it's basically an amalgamation of like dozens of banks that they've acquired over a period of time. Every bank walks in with their own core banking system. Yeah. Every bank has its own like a mainframe and an AS400. And now the tech team and the engineers need to scotch tape this whole circus together. So there is some reality to the problem on why these banks could be slow.
Well, and the funny part is we probably give them a little bit too much of a hard time about being not very fast. But you just brought up a very good point. I mean, these are fragmented systems that were done through acquisition, that are legacy, and a lot of times FinTech founders, and I love them so much, but they forget that a financial institution is governed and regulated by federal and state regulators all the time. So if they move too fast and they break something and they lose somebody's money, they get in a lot of trouble. So they kind of have to move a little bit slower. Now, that doesn't give them a free pass to having tons of technical debt and all these other things. You and I have talked to plenty of financial institutions where they're realizing that's a problem and they're trying to figure out how to modernize. And then that turns into a whole nother piece of how do we migrate? There's just so many things that go along with that. And that is something that, unfortunately for us, unfortunately for a lot of other folks, they don't get to experience that. And so they don't have that perspective. And they just like, you just move slow and you don't understand what I need. And I got to do this. And I got to make there's like that tension that doesn't need to be there if there's just a bit of understanding.
I think that's a very interesting take and an interesting perspective. And you're spot on correct about some of these real challenges that banks have. But the one common thing that you would observe if you're running, let's say, a consulting business, you want your biggest hitter could be an HSBC or a Citibank. The bigger the problem, the more successful you're going to be as a service provider. My big challenge and my big issue was one of the assessments that we were doing for JP Morgan Chase back in New York was they wanted us to look at their third-party relationships, which technically included a lot of fintechs. And at that point in time, I distinctly remember the two top of their lists were Amazon Payments and Block, Square at that point in time. And I'm talking about 2011, 2012. I didn't know what Square was. I went back home, ordered the dongle, and I started playing around with it. And I was like, wow, this is mind-blowing. This is very cool. You can move money very quickly.
Yeah.
But then the bank's take on Square at that point in time and on Amazon Payments was, feel free to shut this down. This seems too risky, because the immediate take that the compliance team on the bank side had was, oh, this dongle, I can stick it to my phone and people can now go and sell crack cocaine around the corner to school kids. And in my head, I'm thinking that the first reaction that I had living in New York was, hey, if you're at a cart trying to order chicken over rice, you always needed cash, right? This is going to be phenomenal for both the consumer and the vendor. Or if you want to sell your couch on Craigslist, you can actually do it using the dongle. You don't have to exchange cash. And imagine if you're, let's say if you're a woman trying to like sell something on Craigslist. And at that point in time, you are trying to go and handle a lot of cash or deal with someone who has to handle cash. You might feel very uncomfortable, but them doing this as a card transaction, fairly easy. So there was an aha moment that I had about like, hey, fintechs being cool, but there was a cooling off period. I still moved to London to fix HSBC's problems, but the big issue was the problems weren't getting solved. So I was very disillusioned.
You're talking about problems not being solved. One of the things that seems to be interesting when we talk about fintech and startup and all these different things is capital. and getting access to capital. When you bring on a big client, like you've been talking about, you bring on that lighthouse client, a lot of times you have to figure out, how do I hire the people? How do I do this? And the fun part is that everything with a big client always comes with more expenses, which means that you need more money, more capital. Like how did you not go to like venture capital to get rolling? I'd really like to understand that just a little bit more.
I've had a lot of experience in building out 2 or 3 new books of business for larger consulting shops, knowing how much effort you need to put into the pipeline. When are you going to start seeing the rewards? What kind of marketing is important? Which conferences you need to go to? What are you talking about at these conferences? Should you be investing in a booth versus exclusive dinners? So you can imagine that I literally went to a school where they taught all of this, and building the book of work was not a problem. As a thumb rule, I knew it was going to take me at least about 24 months to really have a steady business that could basically not require me to ever go back looking for a job.
Man, the level of mental toughness that you have to have, knowing that you're going to go into something that you're going to have to grind out for maybe 2 or 3 years with like zero or no little salary, just through brute force. Like how did you get yourself ready for that? And then like, how did you kind of work through? Because I mean, obviously, not pink unicorns and rainbows and flowers the whole time. Like, kind of walk us through that. So it's actually interesting. Again, a great question. I appreciate it. Most of my founder friends who I treat as mentors and I go to them for advice, I think a common piece of advice that I did get was you make sure you pay yourself first. Everybody, this is the common theme. You got to pay yourself first. Then you're going to take care of the company. I didn't pay myself for the first 3 years. Not a penny. 3 years, nothing. So you went completely against their 100%.
Guidance. The reason is very simple, Tad. So in my head, I'm looking at what I'm going to pay myself for the first, let's say, 2 years. And I'm also looking at that cost and saying, hey, maybe I should be able to go back with that cost and comp, hire maybe 2 phenomenal consultants. So you're literally pouring gasoline on this little spark that you've created. So the choice is very different. You can prolong your pain for a little bit longer, and it gets a little frustrating. But if you're confident, like your customers are coming in, you're able to deliver high quality content, you're getting repeat business. These are all signals that if I had to go back and do it all over again, I'd do exactly the same. That's also my advice to any founder this is like contrary to like Kong belief, but at the same time, I also feel that I've been very fortunate and lucky. My founding team has been absolutely stellar. They're remarkable folks, very experienced and seasoned in what they do, our customers and our relationship that we have in the market. Getting like private equity and VC money early on definitely makes your life a lot more easier, and it allows you to make a lot of sensible decisions. And there's like a very interesting piece of advice that somebody else also given me, which was you got to spend every penny irrespective of what the source is, like it's your last and final. So I have no shame to say that the company is bigger than any personality whose face might be on the company, but at the same time, every penny is very, very important for the business and for the people who run the company. So we try to be as stingy, but at the same time, not getting PE and VC money was a massive boon, predominantly because we're also in control of our own destiny. We can decide, like right now, the company, apart from doing all of our compliance and reg tech and tech work, we are heavily, heavily investing and focusing on AI. We are trying to build solutions and tools and strategies for ourselves. If they work for us, they're going to work for our clients. We're not trying to build tools and go to our clients, and we're not trying to tell them you should buy what we built for you. If the same tool works for us that we're using to provide them services, it's eventually going to work for them, gives us a massive advantage over the biggest consulting firms out there. Our margins are going to be higher. A 50 people company can do exactly what a 60 people consulting company, a 600 people consulting company can do. So again, if we would have probably have not had the first 3-4 hard years, I don't think we would have been able to do a lot of this. Then the focus right now would only have been on like margin and profitability and just growing and scaling the business with the select set of services. We're very happy to be where we are at this point, but anybody who can sustain the pain for the first few years, I would always advise you to do it if you possibly can. If you can't, getting PE VC money is not a bad thing, but it's just that you're compromising on some level of independence and bigger rewards towards the end of the tunnel.
Yeah, that's a conversation that I have with a lot of entrepreneur friends of mine is how do we raise capital? It's not that we don't raise capital. It's like, how do we do it? Are we doing this as a debt engine? Are we doing this as an equity play? Are we doing this like how are we managing through that? Is it there's so many different ways. Those are the two most common. So I'll just stick with those. But like those two plays, and it's so interesting. I can always tell those organizations that need capital that are confident in themselves versus not confident in whether or not they're going to make it actually happen based solely upon what kind of funds they take.
That's a great, I think that's a great point. I think my take, and you're right. I think raising capital is a great thing. It's like adding more and more fuel to the same fire. I do feel that raising capital as a founder, if you're more in control of your destiny, which means you've got the customers, you've got the product, you've got the services, your business is well tested, then you're raising a lot of sensible capital. You're not raising capital on PowerPoints and saying, oh, this is the market cap. I'm going to go and acquire 1% of the whole industry. So I'm going to go and beat Airbnb at their game. It all looks great on an 8-page pitch deck. But in reality, if you've been able to like build out a $30, $40, $50 million business and you've got like real customers and real services and you've seen the real problems, and then you're facing issues like, hey, for my global expansion, I don't need like $10, $15 million here, and I need to invest in products and internal system, whatever it might be. You exactly know with that capital influx in your business, you can go and 4x, 5x the company. That to me seems like you being in more control of your destiny and your companies. And if then that doesn't work, that's probably because of, again, mistakes you could potentially make, or maybe the timing not being right. But if I had to go back and invest in a similar business, I would love to invest in a company which the founders have like really tested it out and they've got like a real use case and the business is somewhat on the trajectory to be profitable. I think that's a good business in my eyes.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
Well, we've talked about capital, we've talked about lessons, all this fun stuff. So I want to get your perspective on what you see founders get wrong the most. And one of the things that we talked about, and I know I ran into this when I first started my firm, but why do you believe that most advisory or consulting firm founders just stall once they get maybe that second customer? You know, you get one, then you get a second one, and then it feels like it's an insurmountable task to get that third one. Why does that stall? Why do you think the stall happens?
I'll give you the practical things that I know, but before that, I'm going to use an analogy that we use very commonly in our company. Coincidentally, we've got a lot of folks on our side who love French food. I don't know why. It's not by design. But the one analogy that we use is, if you love French food, that's one thing. And if you're saying, hey, I love French food, I'm going to start a French restaurant, that's completely different. liking French food and running a French restaurant. These are like poles opposite decisions and activities. Liking French food is being more of a connoisseur. Running a French restaurant is just knowing the economics of the business behind the scenes. Two different things. I think that's a big fallacy that I see a lot of services founders run into. Most of them are really good subject matter experts, your space very well. I get a lot of outreach and I used to invest a lot of my time. I still try to help as much as I can where somebody's going to reach out. They'd be like, hey, I'm launching my company. I'm going to do like payments advisory and I'm going to do compliance and I'm going to do blah, blah, blah. Can we partner with you guys and go to market together? And my first reaction is you started your company on last Monday, right? Happy to help you. If you're talking about a partnership, I don't know what you're bringing to the table. I know what I'm bringing to the table, right? But I would spend a lot of my time with them. The reason is I have a lot of PTSD from my early days being alone exactly in this chair. You wake up at like 9 a.m. You're like, this is my first day of my new business. By 11 a.m., in 2 hours, you're done. Your strategy is there. Your website is up. You have no customers and you don't know what to do with your life. And you start watching Netflix the whole day. And then you wake up the next morning and you're like, I think I'm wasting my life and I made a wrong decision. And this cycle repeats till the time it doesn't. So I kind of feel like I owe it back to the community. So I'd sit them down and I would genuinely, in my early days, I would spend a lot of my time saying, hey, I've got an accountant. I'm going to set up your website. I'm going to help you here and there. But now I take it a little bit easier and I really ask them, why do you want to do this? Did you just lose your job and now you don't have a job and you think that because the barrier to entry is so low, I'm just going to go and start a consulting firm? There is a significant difference being...
There's a lot of that.
Yeah, there's a lot of that. And there's a significant difference between being a sole contractor, which is a great thing for you to be able to be more independent versus saying, I'm going to scale a consulting company. It takes a little bit of time. I think now I've got like this sense that you're like, all right, I want to see what you're going to do for the next 3 to 6 months. There's a very high likelihood you're going to find a job and you're going to go back.
Yeah.
And if not, then the only outcome going to your main question is the question is like, you're going to find your first customer and your second. How do you do your third, fourth, fifth, sixth? And how do you just ride this tiger to the end of the world? I think hustle is insanely important. Speed to market, very important. We have our customers sitting in New York right now. It's like 4 p.m. in San Francisco. If I get a call right now from a customer who wants to like meet me for lunch tomorrow in New York, I can absolutely promise you I'm going to be on a flight in the next 3 hours to New York, even if it's a cup of coffee or lunch. It's very important to listen to your customers and be out there. At the same time, services that you're delivering, you have to be top class, top notch. Your outcomes have to solve problems and not create more problems. If you can triangulate these two, and of course, you got to have a phenomenal team. If you can triangulate these 2 or 3 things together, I feel like that's a good recipe for success. But that book of work always being warm, leads coming in, you talking to the right people, understanding who your buyers are, being able to convert those opportunities. I think that's probably the holy grail. It's a simplistic formula, but that's what works for us.
So not to beat the horse till it's dead, but if you could say, here are the 2 or 3 reasons that a founder in their first year stall out with maybe 1 or 2 clients, what would be the top 3 reasons for that?
Top 3
from
reasons.
Your perspective.
You don't move fast enough. You don't have the capacity. You're not able to build a team. Every time you win some work, you're trying to like feed yourself first and take all that revenue back home. Don't do it, right? Find a team. It belongs to them. Let them use this as a co-founding team or as a first set of employees. Take care of them. There's more revenue that's going to come that you can take home eventually. So I think that's the second one.
And what's 3?
The third one I genuinely believe in, and I think it's just not me, the entire company on our side. And this is more relevant for consulting and services businesses. You're an expert. Definitely your thing really well, but your customer is why you exist. The day you start undermining your customers, the day you start feeling like, oh, my customer is a fool, let me just price gouge them. They've got their backs against the wall. Let me just take all their money. They're looking for advice and let me first charge them for my time and then I'm going to get them. We just don't know how to do that. Our customers and their businesses, we genuinely believe like they are our businesses. We have contracts in place, and there's so many contracts that we kind of go over budget. Our margins, we try to work very hard to make sure that our customers are happy and they're successful. Yeah. The revenue and the margin eventually in the long run, it's all going to come. And if you are able to build that rapport with the founders and their teams, I can absolutely promise you, they become your sales team. We have all of our founders who are closing deals with us with other prospects. Our prospects are calling us and they're saying, hey, what qualification credentials do you have? I say, hold on, what? Don't listen to me. Here is another person and 3 other founders who are your competitors. These are their phone numbers. I'm going to connect you guys. Talk to them. And they then sell and close deals for us. So these 3 things is what I would strongly recommend.
I want to hit on one thing just really quickly. So one of the things that stood out to me is like, don't take all the revenue yourself, build a team. What does it really take to scale a team to 40, 50 people? What is it like? Yeah. How do you do that without imploding?
So we know how to fly this space shuttle, and I'm being very candid and honest. We don't know how to land this. We know how to go from 0 to 40, and we right now 50. But if you told me scale back to like 40 or 25, we don't know how to do it. So there's only one direction for us. How do you do it? I think it's like sitting on a seesaw. If you overhire, that's going to kill your company. There's no question, because you can't run the payroll, and you undersell, that's a problem. If you oversell and you don't have enough people to deliver the work, your clients are not going to believe that you can take them to the next level, which means they're not going to come to you again. So it's always that balance. So the first few folks who we had to hire, it was a very hard sell. The reason is your pitch is, we're going to do something absolutely phenomenal that none of the other consulting firms have done. You should come work for us. We're going to go and target these amazing clients. They were not even clients at that point in time, right? It's just a dream. At the same time, we're a bootstrap company. We don't have any money to give you. So, and you're also saying that we need the best of the best of the best people who are going to be on this side of the company. And people are scratching their heads thinking, wait a minute. So we're not going to get paid as much as we're making right now. You're going to make us work harder. The only upside is it's going to be a different company and a different environment. We're going to be in a flatter ecosystem, and we're going to play with these really phenomenal customers you have. The answer is yes, right? Now, the first one is very hard to crack, right? When you have one person on your side, you're like, oh, we're a 2-people team. So you go to the third one, and the third one suddenly is thinking like, oh, there's not one, there's actually 2 people. So maybe they are legit.
So there's that whole momentum starts to build
Now you're
up.
3 people. The fourth one is like, maybe, but okay, I'm gonna try this out. So this journey began like a couple of years ago. To a point, our number one problem used to be the person who's walking in. What is our pitch gonna be to them? How are we gonna go and convince them? And I take a lot of pride in the hard work of the team and things that the team has done, the culture that they've been able to build. Where today, when we put a job post out there, that we don't have recruiters, we don't pay agencies, but when we put a job post out there, it takes about an hour, and our post maxes out, and we don't have enough people to go through those resumes. Every time I see a pile of resumes, and somebody on the team is complaining like, oh God, we have to go through all of this. There's a part of me that remembers, hey, the first one that we had to go after, it was so hard for us to make that pitch. So I do feel pretty blessed, but to your point, just go find your first 3 or 4 people who are absolutely phenomenal. Give them what they deserve. Give them the opportunity. Everything else is gonna follow. I'm a huge Field of Dreams fan. As they say, if you build it, they're gonna come. I think that's the whole theory that at least I live by.
Growing up in Iowa and not being far from that field of dreams, I guess I took on a little bit of that myself as I was building out my organization as well. And it's been really interesting. You get a couple people that see the dream, that see the vision, that see the direction, and it just builds from there. And you can never do it without, and I think this is the big piece that a lot of founders don't think about, is that you've got to have cheerleaders that are outside the organization. You've got to have those people who are Team Jas or Team Ted that are like, hey, no matter what you do, I'm going to figure out a way to help you be successful. And that to me may not be the team that you have as on the payroll, but that team to me is just as important, if not more important than the people that you bring onto the organization. Because when times get tough, not if, but when they get tough, because it's going to happen, you've got to have that phone a friend or phone a person, whoever it is, to say, what do I do? How do I get out of this? What would you suggest? That maybe has been through it before. And so that's one of the things that's really helped me with my team and building out everything, is being able to go to someone like you and others and be like, this is what I'm thinking. Help me understand like what I'm missing. And I think that's been a really, really big piece for me to be able to not overextend. And you said it in a way that I've heard many times before, is like, I sometimes I underspend because I'm worried. And I shouldn't say worried, but I'm looking at it from a very fiscal perspective of, if I spend this money, where am I going to make the money to make up for that? If I hire this person to come on board, what are the things that I need to do, and how close is my pipeline to doing those things to get it to happen? And so many times I've been told, just spend the money, Quit thinking about it. Quit trying to figure out where the money's going to come from after you spend it. Just spend the money, have full conviction in it, and you'll make it. It'll happen. It'll happen. So as I'm listening to you talk about it, these are all the things that are going through my mind. So I'd love to see if you've got any rebuttals on that, or any additional thoughts on it.
I completely agree with what you're saying. I'm trying to find the right maybe words to amplify that, but your team is like the engine of your craft. Like, you've built a phenomenal craft. This looks pretty. It's got all the right bells and whistles. But at the end of the day, I love the fact how you mentioned about having cheerleaders outside. Our outbound sales is zero. Like, and it shocks a lot of people when I go back and say, hey, we don't run any campaigns. We do LinkedIn marketing in-house, but we don't track and triangulate, and we don't like show up at like doorsteps. We don't do any cold calling, no direct outreach. We do get a lot of cross referrals, like customers who we have done a good job at. When the other friendly CCOs are looking for help, they call another CCO, they connect them to us. That's like job half done. Half of my sales is like when I got referred by another CCO. I think that goes a long way. But in terms of like people, the one conversation that we have in our company like very frequently is, we've got like good relationships in the market, good brand credibility, putting our foot in the door and opening up that door. We've learned that skill and that art very well. We finessed it to a point that we can literally open any door that we want to today. But the big thing from a consulting business, sustaining a consulting business, is how do you keep that door open, right? If we land, a good example, if we land ByteDance as a customer, right, which we did like a couple of weeks ago, it took a lot of hard work, a lot of rigor, a lot of chasing. It took us almost about a year and a half of having just conversations. And at some point, we're like, all right, we're in. Now, a company of that size and scale, it's like a Citibank in our realm, right? You can't let that door close. The reason is they've got a phenomenal compliance team, great products, but they've got their own challenges, which means there's always going to be room for everybody to be in that room. So I don't want to be the guy who opened the door, did like one engagement or a second, then I get out. I'm staying there. So my job to stay there is, the way you do it is you do an exceptional job without gouging the client. If the client can trust you and they like your advice and they think you've got the right experience and the right people in the right team, you're not going anywhere. So opening the door, I can do it and we can get in and we can do the first one well enough, but it then totally depends on the team. To your point, if that team is well taken care of and they're a good team and they understand and they want to learn and they can hustle, then that ends up becoming a multiplying effect. So while they're keeping the door open, your job is then to go open another door and another door, and you keep deploying teams, and that basically puts the whole circus together. But I think, just trying to do all of this all by yourself and taking everything back home, you can maybe do one, maybe a second door. We can't go beyond that.
I thought it was interesting having them wanting to learn and experience things. One of the things that as I'm talking to folks and they're like, "Oh, I'd love to join," or "Hey, this is what I'm looking for." And there've been a couple folks that I would love to have on board, but I'm going to throw that word in there. Their level of curiosity about a problem, a situation, or how to change the direction of something just isn't there. So great person, very knowledgeable, and I shouldn't say person because it's multiple people. They know their stuff really, really well. And the desire to learn additional things is lower than I would like. And so it's like kind of some areas that I start to push back on and everything. But what I do want to do at this point is we've talked about the people, we've talked about the experience, we've talked about how to help all these different things. But one of the things that Strategybrix is known for is compliance. And I want to make sure that we talk about a little bit about that because compliance can be done right. Onboarding and ongoing risk monitoring. What would you say if you look across the entire scape of your clients and your experience? What are the 3 most common mistakes companies make, and then why?
Heavy question. All right. Number 1 common mistake that we've seen in the fintech space, particularly just hiring wrong compliance officers with the compliance team, not having the right appetite. And I can double click on this in a second. The second common mistake is, I think, first principle thinking missing in compliance is a huge, huge, huge problem. Companies who do it right versus companies who don't. It purely stems from compliance teams having the ability to do first principle thinking versus the ones who can't think creatively. So that culture of being creative, and by being creative, it doesn't mean that, oh, you got to say yes to everything that businesses bring to the table.
Yeah.
A lot of times your response largely is that this is not an illegal business. We can do it, but we're not ready for it. To be able to compensate, to be able to take that risk, I'm going to need to build some guardrails. You need new systems. You need more people. You need some investments, but talk like a mature adult in a room and not like kick your tires and be like, we're not going to do it. It hurts my feelings or whatever it might be. I think that thought process I feel is something that doesn't work well. The last, and probably this is the biggest one, is you got to have a really, really, really good handle on technology. Gone are the days like the HSBC example that I was using where you got a big problem. I remember like there was a ginormous look back, thousands and hundreds of thousands of alerts that popped in. The question was not like, why did these alerts show up? The question was not like, hey, can we go and like retune and refine the system that we have the right systems? The first question the execs asked was, how many people would it take and how much money would it cost? The answer was 600 people. And then the next, how quickly can we get them? And I'm kind of sitting there scratching my head thinking, your job as an executive is to challenge what just happened here. But from a bank standpoint, it was like, let's just find 600 people and get done with this problem. That is gone are those days. If you're running a financial services business today, you could be a sponsor bank, you could be a crypto exchange, you could be a payments company. Technology is your friend, and the way with which technology is moving, technology is going to augment your team really, really heavily. So if you don't have a really good control on your systems and you're using these systems as a checkbox type activity, it's just not going to work. So hire right, make sure the team has a first principles mindset, and have a really good grip on your tech.
So the one thing that I think is interesting that you brought up, because I always get asked this question, is how much should we budget for risk and compliance? And it's funny they ask that question. I don't know if it's because they're worried about underinvesting or overinvesting, but more of like, how little can they get away with and get the first principles mindset and people that understand the technology. Why do you see people maybe underinvesting in their teams?
Yeah, that's a great question. We get that question a lot, Ted, but the only difference is we charge our clients a lot of money to answer that question. So how do you go and make this decision? I think this decision needs to be made very, very rationally, which is you genuinely need to understand, if you're the one who's going to make the investment, what exactly is your risk and what does it take for you to mitigate the risk? The biggest problem that we have seen in this space is, again, compliance officers and CCOs who are not able to articulate what they need to the leadership. Here's how the scenario plays out, right? You're in Q3, Q4, you're doing your whole budgeting. The teams are working on their OKRs. Product teams are going to go, they're going to build out, like launch a new product, go to like 5 new markets. They're going to do cross-border stuff, yada, yada, yada. They've asked compliance to go do their budgeting and like ask for what money they want. And compliance is going to put like some process together. They're going to do some like, they basically call a lot of consultants that like, hey, how much should I budget for this and that? And you give them numbers. So you put together your pick. You then get in front of, let's say, the CEO, the CEO, and the CFO, and you present your case. Without knowing, this circus happens every year. They're going to throw a lot of punches at you, right? You're like, hey, I need like $100 million. They're like, no, let's just start with $1 million. Maybe, right?
Just give 1%.
It's a negotiation, right? And you start, but then a lot of times the founders are asking the right questions. They're asking you, why do you need this? Oh, we need like 5 people. What are they going to do, right? How much tech have you used? What is your like plan to leverage some AI? How are you going to go cut costs? And these are questions you should have anticipated because every CCO gets asked exactly the same question when you present the budget. And by the way, it's just not the CCO. The CRO is getting asked the same question. The CPO is getting asked. Everybody's getting asked.
Everybody gets asked that question.
But I don't think the CCOs most CCOs have that muscle where you've anticipated these questions, you've prepped a pitch, which is strong enough, and you're walking into a negotiation. Now, what ends up happening is when you ask for this much and you're given this much, you just walk out crying like a baby and you feel defeated and cheated. And your basic pitch back to your team is, my leadership doesn't believe this is not a culture of compliance. They don't believe that we should be. That's not what just happened in that room. What happened in that room was you lost a negotiation. You were not able to articulate. And the one thing, and I worked with some phenomenal CCOs. I learned the ropes from them. They're really good negotiators. Most of my friends, when they're doing their first time CCO gig, that's my advice to them. Hey, not even me, talk to these people, right? This is what's going to happen when you do your budgeting. This is what your argument should be. And this is how you get what you want and be happy. But then once you get it, make sure you go and tell your team that we got what we wanted and we won. You can't rally troops as a defeated general. That's never going to happen. It's never going to work. So I think the good ones do it well. The ones who are still maybe not there, I think they struggle a little bit. But every time you have this imbalance in the equilibrium, we know that the relationship between compliance and business is not great. This is also generally a warning shot for leadership. If you're the CEO or the CEO running or CFO running the org, if you see that your CCO is not ready to fight that fight and they are basically getting defeated every time they open their mouths, train them, help them, because either you've hired wrong and you can't get rid of them now, or if that's the messaging that you kind of throw a couple of punches and they just take it lying back and then they go back home, it's just not going to help the organization in the larger run. You might have won that battle for sure. So I think that's a huge challenge that we do see.
Well, one of the things that, as you talked about the CCO and the CPO and the CMO and the CRO, I think I'm missing a couple C's in there. CTO, I've missed that one. CI or CSIO. I mean, we could probably acronym ourselves to death with that one. But a lot of times there's a poor alignment between product, sales, compliance, finance. It's like there's just this bad alignment where it's focused one way or the other. A lot of times it comes down to the negotiations that you're talking about. You have a really good story about how those team members came together. It was a public company. They had over 2 million partners. They'd gone through vendor selection, but they were having a huge drop off when it came to customers. Help us understand and maybe break down how onboarding design or other things that go along in the ongoing that really help them regain that scale.
Yeah, I think so. They're still undergoing a lot of different aspects of this journey. It's a public company. It's they're ginormous in size. They went down the regulated route, and their internal teams on the compliance side were asked to design like the onboarding flow. And it was a little bit of a clunkier onboarding flow. Again, missing first principles thinking. It was missing a lot of benchmarking. when you look at your competitors, the more high-powered ones, and you stack yourself against them, the answer should be pretty evident. Like, why is it that we are struggling to onboard? And I don't remember the top of my head, but it was like a couple of tens of thousands of friends and family users that they tried to port over. A very, very, very small fraction went through the pipe. And that's when we were summoned in to help them understand what exactly is going on. When we started mapping out the onboarding process, we figured out all the choke points and the drop-off points. It was quite evident to us that the whole design and what we were asking for in that flow, it wasn't intuitive. And in today's world, as we all know, consumers have a lot of
That's
options,
not an option.
right? If you're going to make me sit for another 15 seconds to click my selfie and the wheel is spinning, I'm gone to the next institution because they're going to onboard me almost instantly. So apart from like tactically helping them fix the problem and fix the onboarding process, we found them like more cutting edge vendors. Their straight-through processing rates are going to be a lot higher than what we'd even initially anticipated. I think there is something to be said about how do you make these decisions internally. So onboarding as an example, my general recommendation is it is like the front line of your business. It's like the bank branch you walk into. You can't have compliance design that branch, right? Compliance is a second line function. That's its job largely is to make sure the policies that you've written, implement them well, protect the bank and protect the partners and protect the ecosystem largely. But the first line, which is the product line that should be responsible for designing the onboarding flow or the face of your institution on how customers enter your platform, they need to be very creative. They need to be very creative. They need to be very competitive. What they need to understand is what is the minimum of my policy, right? When you say KYC, what does that mean? In that policy, it's very clearly mentioned that you're going to ask for an ID, you're going to ask for a 2x2 check or the dog's date of birth or whatever you need. At some point, you need to have the muscle within your company to even go and challenge that policy. When your compliance officer is coming back and saying that, oh, I need the dog's date of birth, someone needs to take a step back and be like, why? Where is it written that I need? Is it for your comfort or is this what the regulation wants? And look, there's no right or wrong answer. What's important is for all of us to know what the bare minimum is, what is required by the rule book, and then what's important from the compliance officer's standpoint to protect the company. They might not be wrong, right? What they're asking for, maybe that's in the best interest, but that's a negotiation. So largely, the policies need to be understood by the business and the commercial teams. They need to then design very cutting-edge systems while protecting the policies. And if you find something funky in the policy, you go and argue that out for their compliance team and change the policies. On the flip side, your compliance teams need to design policies that are more practical, in line with the rules and the regulations. The reason is the market is very competitive. Just because the policy protects the bank, it also ends up kicking every customer out. If you're going to have no customer, guess what's going to happen? You're not going to have a job. So it's very important for you to make sure that you let the good actors in, protect your partners and your institution, but at the same time, be more commercially oriented. So having that mindset on both sides is very important. And one or two maybe practical tips that I'd love to share. I'd also love to get maybe your perspective. You swim in this pool day in and day out. We've spoken about this so heavily. I think a tip that I've generally given to a lot of CCOs is make sure you've got like people on your team who are embedded with the product teams, right? When you're going to new markets, when you're discussing new product launches, when you're discussing requirements, have somebody who understands the policy. They don't need to be very senior. They're your ears and eyes to what's happening in the market within your company. These people need to know the policy really well. So the moment you go back and say, hey, we're going to do something absolutely funky, they should just raise their hand and say, hey, but per policy, you can't do it. If you really want to do it, this is going to become a huge problem. Go talk to the CCO. However, if everything is legal, they want to do something funky. This team just needs to bring that knowledge back to compliance so that compliance officers are ready to fight that fight.
You're building a fintech product. You want to offer digital assets, but wallets, that's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs payment platforms, and custodians, choose Dfns. They provide wallets as a service that's API first, multi-chain by design, and secured with MPC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Dfns. MoonPay scales wallets securely with Dfns. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Dfns to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Dfns wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Dfns, secure wallets built right.
You're going to be fine.
My perspective, and every CCO is probably going to be mad at me for saying this, but as soon as the organization calls you the sales prevention department, that you're definitely headed the wrong direction. And that can be remedied super quickly and super easily. And really that's looking with a commercial compliance mindset first and figuring out how do I get involved in what's going on? What is the sales team seeing? What are their clients going? What is the product team hearing? How are the engineers approaching these things? You don't have to be like super embedded into it, but like from my experience in doing lots of product development, I spent most of my time looking at the policies and asking the questions like you said, is like, why is the dog's name in this? Do we need the dog's name now, or can we get it later when the dog asks for a treat? Like those are the types of questions. And really from the product and engineering and sales side, they need to be asking those questions of their compliance teams of why are we doing this? Is there another way to do this? Is there a less friction approach to take to get the same result? And so like I've seen, I mean, heck, I've been doing this over 26 years now, and I've seen where there are CCOs that are just headstrong that the policy is the policy and it's got to be the letter of the law. And I'm not saying that we need to say forget all of that. That is no stretch of what I'm saying. But what I am saying is let's look at why we're challenging that. Why are we challenging that policy? Why are we challenging that procedure? Why are we challenging that one artifact? Why? And is there a reason that we can get away from it? Or maybe we get to it a different direction, at a different time, a different trigger. I mean, I could go on for days about all those different things. Can you share some examples of that from Strategybrix clients and things that you've kind of worked through, and maybe even some of your own experience?
In my experience, I think there's like less than maybe 4% of CCOs who I know in this industry who are really the real deal CCOs and who are moving their companies forward. Very important for not just the CCOs, but also their teams to understand that it's unfortunate that every time something doesn't work out, you do get blamed. However, if you work very hard at making a deal happen, going to a new market, and you win, unfortunately, you're never at the podium for some reason, right? You always get left behind. It's okay. That's the job, right? There's a pecking order. There's the commercial teams, there's sales, and there's marketing, and there's a lot of other front-facing teams that are always going to be at the podium, and you get left behind, your teams get left behind. It's all right. But the biggest thing that I've at least learned from some of the finest CCOs is the fact that be commercially minded, but when you say no, everybody backs off and they don't challenge you too much, because that's the level of respect you earn for yourself. That's how reasonable and rational you've been in your arguments all this while. Mm-hmm. And you've built that trust and equity in the business. When you go back and say no, the CEO almost immediately knows it's not good for them, not good for the company, and not good for their portfolio. They will support you and they'll back off. So earning like your stripes to get to that point, I think that's the hard work that most successful CCOs do, in my opinion.
Is there an example from your experience or a client where you've seen them do it really well, and why was it done really well?
Yeah. So I think 2 or 3 examples that come to my mind. There are 2 big differentiators when you look at these teams. 3 maybe. The CCOs that they've had, respectful, they play very well with the commercial teams. When you sit down with the CPOs, when you sit down with growth and marketing teams, they see you as an equal partner because you're speaking the same language, you're at the same level, you're very rational. Second is, it's a common distinguishing factor where all 3 of these teams have technology components embedded within the compliance team. What that means is you got people who, there are sub-teams that are responsible for onboarding systems, ongoing transaction monitoring, sanctions training, and a few others. So you're kind of holding your own destiny, which also means that when you start having discussions about compliance agents and using AI and all of that stuff, that's not a different team. That's a team embedded within your team. And the last one is all of these teams have the same subcomponent that you see that they have smaller factions which are plugged into the product teams. And the compliance officers almost instantly know when something is about to change on the risk profile. New markets, funkier clients, new partnerships that are going to expose you to risk. And they can then, once they are notified and they have a seat at the table, they can then go and either slow business down and tell them like, hey, give us 3 months, we're going to be ready. Or invest in these systems that we need and we'll take you to market almost immediately. Or they just go back and tell them, hey, by the way, we've explored this option 2 years ago. Outside counsel pretty much came back and our examiners came back and said that this is not going to fly because it's, let's say, not legal. They're able to like score that before anything is too late. So I think these cheap examples that I used, I think they've got the right combination in terms of what the structure of these teams should be, what the communication, the governance standard should be. I think they've done phenomenally well for themselves. And kudos to their leaders. They've had leaders in all of these places where once they sit in front of the commercial teams, and the same example of when they say no, they listen to them and then they back off fairly quickly.
You've mentioned it a couple times, and even especially in what we were talking about here with these teams that have done really well, is that they've looked at AI automation, machine learning, but the one thing they didn't do is like eliminate the human factor. Now, there are companies that have come out and said it. Our fun friends in Europe, Klarna, decided that they were going to tell everybody they're getting rid of everybody, then backtracked a little bit when things didn't work out exactly as expected. But I would love to get what your perspective on what you're seeing, because I'm seeing these organizations look at AI as ways to be a force multiplier and to be able to make, I call it reason, but the former head of engineering for Microsoft's Copilot told me it's not reasoning. So I will say that it is the decision of, is this good or is this bad? Still remaining in the human side, but all of the analytics to decide the reason to decide good or bad really falls into those. But circling back, what are you seeing? What are you hearing? What are the skills that the CCOs that you work with say that their people need to have in order to stay relevant?
That's a great, heavy question that very front and center, and it's gonna impact, AI is gonna impact compliance more than any other function. So the whole Klarna story, I think they overdid the whole AI aspect on a lot of user ops, right? And the model started bonking, and at some point they decided they're going to go back and rehire, but they're going to go back. Once the models are finessed, they're going to go back to using the agents. And it's basic commercial sense. If the machine can do this for you while you're sleeping, there's no reason for me to like hire people. And again, it's not in a bad way. The challenge is no two humans perform alike. The same human at different times of the day doesn't perform alike. If you're running a business, you need that consistency. The machine can be consistent. That's a huge difference between a computer and so I think that's a big differentiator. Now, why compliance is going to get impacted most? 2 reasons. One, it's the most rinse and repeat function where 60-70% of your investments are looking at alerts, follow a 10-step process. If this, then that, then do this. And it's a very robotic and a monotonous process that you have to carry out. There's definitely a lot of nuance, a lot of complexity at later stages if you find something egregious, but you're looking at false positive rates of like 95, 98%, which means for every 100 alerts, 98 are basically garbage. And what that means is that the machine should be able to disposition them. It's also a very uncool and an unsexy area where no kid popping out of college is like, I'm going to go become like a compliance analyst and look at alerts. So no one really wants to do it. We've been tracking machine learning and AI for a very, very long time. I was never bullish on machine learning per se, predominantly in the financial crime space, because model validation based on the current regulatory landscape becomes very difficult for machine learning based models. However, the advancements that we have seen on the Gen AI side are mind blowing in the last 1 year. The government is working twice as hard to come up with some guidance that's going to allow all these companies to basically use these large language models, because if they don't, the companies are still going to hop onto that bandwagon one way or the other. And that's already happening. Yep. So my general advice to CCOs, analysts, like everybody, firstly is roll up your sleeves. Like the large language models, these are your friends and not your enemies. In my side of the world, everybody is looking at these models. They're like, no, they don't work. The machine can't make a decision. Regulators are not going to let you do it. Guess what, buddy? Like we live in a capitalistic economy, right? If the founders and these companies and banks, they're going to be able to save a dime, they're going to make this happen. And
one of it's interesting as you bring that up, that they're not going to trust the model. Well, it was last year sometime, and I don't remember exactly when, but I remember when the Fed spoke at MIT and they were talking about the AI washing of just about everything. And they were telling financial institutions and other financial product companies, hey, it's okay that you say you have AI, and it's okay that you say that you're solving a problem with AI, but you have to be able to explain the input, what's going on in the middle, and the output. So if you can explain what you put in and why you got what you put out, you're going to be okay.
Unfortunately, when you're dealing with machine learning and AI models, the explainability aspect is a little bit different. What that means is you need to, and there's like a lot of complex ways. Think of the best analogy that we use again is a self-driving Tesla takes you from point A to point B, or a Waymo in San Francisco would take you from point A to point B with no drivers in them. These industries are pretty regulated. They are given instances of, situations and how the car would decide if guys to go left, run over somebody, or make some extreme decisions. There's a lot of complex testing and validation done. Some of the models that they use, you could definitely leverage similar theories, but the most and the biggest thing that needs to happen is you have to be able to go back and explain how these models are working to these examiners. These are very complex models. They are not as simple as if you put these 5 inputs, this is going to be the output. If you change the inputs, what the new output is going to look like. So bringing them up to speed is going to be very, very important. And I feel like whichever company is able to resolve that, whichever company is able to build that relationship, I think that's going to be a huge, massive advantage for them in the future.
I'm just glad that they're not scared of it anymore, right? So it's like for a long period of time, it was like if you use artificial intelligence or the acronym AI, they froze and you were treated as a criminal. So I'm just glad that that's no longer happening. But what I want to do as a founder that has bootstrapped, if you could give fintech founders one piece of advice, that's the only piece of advice they could use going forward, what would it be? And in one sentence.
So my one piece of advice, and this might be a little bit unconventional, is you gotta run and go for profitability, right? I fundamentally do not understand multi-generational businesses that we are saying that, we're going to raise capital, or we're going to sell service, or we're going to do a bunch of stuff, but we don't know how we're going to make money. I think, how do you make money? How do you go profitable? How do you make it a real business? To me, is you could be a 4-person company powered by extreme AI, or a 400-person company I think that has to be front and center, and it has to be in the near future. If you tell me you're going to be profitable in like 150 years, like, yeah, that's great. And I'm sure it's good for like a lot of different businesses. But I think having a goal in the near term, very important. And if you're thinking about that 24/7, I think that's probably something that is definitely, in my view, a road to success.
So what I got out of that is focus on profitability and you'll be okay. That's what I got out of that one. And Jas, man, there's so many more things that I want to dive into, but we've run out of time for today. Thank you so much for being on today.
Thank you for having me. I have been an avid viewer of the show for a very long time, and for me, it's been an honor to be here. And it's a milestone that I've achieved. So from my end and everybody at Strategybrix, thank you. I really, really appreciate it.
Well, folks, that does it for this episode of FinTech Confidential's Leaders One-on-One series. We've covered everything from compliance to strategy to startup. We've gone all over the place and even talked about what it's like to bootstrap and bring something to scale. And Jas, again, thank you for the transparency and getting so tactical into how a lot of these things work. And I want to thank everybody for sticking with us. These conversations are really designed to give you more than service level sound bites. They're here to show you how real operators think, lead, make things happen in FinTech. And so if you've got value from today's episode, make sure that you're subscribed so that you don't miss the next one. You can find us on YouTube, Spotify, Apple Podcasts, or wherever you listen. And if you want to dive in deeper to what we're tracking behind the scenes, be sure to sign up at fintechconfidential.com and share it with someone who's serious about where FinTech is going. And as always, keep moving forward.
As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawk.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.